Obviously, it puts egg on our face, and we deserve any criticism we get, so feel free to give it to us, and we'll probably agree with you.
Give us any criticism, and we'll probably agree with you. And unabashed, should I say, Jamie Dimon apologises to shareholders. He's got plenty to apologise for. His bank, JP Morgan, has declared a surprise trading loss of $2 billion. That's after a strategy to ramp up risk at its chief investment office horribly backfired.
These were egregious mistakes. They were self-inflicted. We are accountable. And what happened violates our own standards and principles by how we want to operate the company. This is not how we want to run a business.
Well, the losses have rocked the whole banking sector, stocks falling across the board in extended trading. And stay with Bloomberg for continued coverage throughout today on that JP Morgan trading loss. China.
There's going to be a lot of volatility here. It could easily get worse this quarter, or better, but it could easily get worse. And the next quarter, you know, we also think we'd have a lot of volatility next quarter.
So more pain could well be on its way for JP Morgan. That's according to its chief executive, Jamie Dimon. He's already revealed a $2 billion loss at the bank's chief investment office. And stay with us for continued coverage throughout the day on this $2 billion loss.
These were egregious mistakes. They were self-inflicted. We are accountable. And what happened violates our own standards and principles by how we want to operate the company. This is not how we want to run a business.
An apologetic Jamie Dimon there, speaking on a conference call to shareholders. He's got plenty to apologise for. His bank, JP Morgan, just declared a surprise trading loss of $2 billion. Well, investors showed their dismay after hours, sending JP Morgan shares down almost 7%. That's $10 billion of value wiped away.
It really damages its credibility as being a good risk manager, and one that so far has managed to sort of stay above the fray and some of the turmoil that's affected other US banks. And also it's affected its Tier 1 capital adequacy ratio, as it's brought them down from 8.4 to 8.2%.
And stay with Bloomberg for continued coverage throughout today. China wins some breathing room. $2 billion gone at JP Morgan. Sue Keenan has the latest on its revelations.
JP Morgan Chase announced a staggering $2 billion loss tied to synthetic securities positions that it admits resulted from a flawed strategy that was poorly executed and poorly monitored. Shares fell roughly 5% in extended trading on Thursday as CEO Jamie Dimon held a surprise, tension-filled conference call after the close to explain what happened.
These were egregious mistakes. They were self-inflicted. We are accountable. And what happened violates our own standards and principles by how we want to operate the company. This is not how we want to run a business.
On the call, Dimon became increasingly agitated with each analyst question. One memorable exchange took place with Credit Agricole's Michael Mayo, who asked if the losses were JP Morgan specific or market specific, likely to have happened at other firms. Dimon answered it was tied to the market, and then added, just because we're stupid doesn't mean everyone else is. Mayo pressed with more questions. In 6 weeks, you lost billions of dollars. How did it happen, he asked. CEO Dimon explained again that there were huge moves in the marketplace, and as they readjusted these chief investment office trades, synthetic trades, to handle it, the trades became more complex and the losses widened. Quote from Dimon, I could repeat it 800 times. We're not going to get more specific than that. In retrospect, the analyst asked, were there any signs that you missed? Yes, said Dimon, trading losses. Obviously, he admitted, we should have been paying more attention. JP Morgan said the losses were partly offset by gains from sales from its available-for-sale credit portfolio, resulting in a net loss for the firm's corporate division of about $800 million after taxes. Dimon said the losses could widen or improve during the rest of the quarter. The bank is repositioning the synthetic position, making it clear on the conference call they were either unable or unwilling to unwind the positions at this point. Sue Keenan, Bloomberg, New York.
Jamie Dimon talks about eggs and errors. His $2 billion loss sends JP Morgan stock down 7%. That's $10 billion wiped out. Our coverage of JP Morgan's shock announcement continues.
Both prospects not good enough. JP Morgan has revealed a shock $2 billion trading loss after its chief investment office made a major error in calculating risk. And that risk remains high, with the bank saying the trades could cost it an additional $1 billion this quarter.
Obviously, it puts egg on our face, and we deserve any criticism we get, so feel free to give it to us, and we'll probably agree with you.
Give us any criticism and we'll probably agree with you. In a abashed, Jamie Dimon apologizes to shareholders. The announcement of the $2 billion loss wiped $10 billion off the bank's market value in extended trading, and the effect was felt across the sector, as you can see there. Well, JP Morgan's shock loss is a gift for the men and women who want this sort of trading outlawed. The co-author of the Volcker Rule says the bank's disclosure serves as a stark reminder to regulators who are drafting the proprietary trading ban. Democratic Senator Carl Levin is also chairman of the Permanent Subcommittee on Investigations. He says the enormous loss is just the latest evidence that what banks call hedges are often risky bets that so-called too-big-to-fail banks have no business making. Well, Dimon disagrees with that assessment and isn't even sure that he would have been in violation of the new rules.
We do believe you need to have the ability to hedge in a CIO-type position, and that Volcker allows that. This trading may not violate the Volcker Rule, but it violates the Dimon principle.
Well, be that as it may, Dimon hasn't done any favors for Wall Street. The big banks are all lobbying for exemptions to the legislation. Well, do stay with Bloomberg throughout the day for continued coverage of JP Morgan's shock $2 billion loss. We're going to have top guest analysis, and of course, we're going to be live on Wall Street as soon as shares begin trading there. So, $2 billion gone in what JP Morgan says was an exercise in hedging that went horribly wrong. Over the last few years, Jamie Dimon overhauled the firm's chief investment office, pushing it to make bigger and riskier bets. But now that's blown up.
Speaking on a conference call with shareholders, the chief executive admitted he'd made a big mistake.
It was a bad strategy. It was badly executed. It became more complex. It was poorly monitored. We obviously don't have to do anything like this at all if we don't want.
And just in the last hour, I spoke to Bloomberg News' Michael Moore in New York. He says this could see JP Morgan fall off its pedestal.
This is quite a shock. I mean, JP Morgan has been the prime standard for banks in the U.S. Up until this point. And, the CIO was something that we brought attention to. Bloomberg News, a little more than a month ago, broke the story that one of its traders in the CIO division had amassed a huge credit position in credit CDS indexes. And obviously that's part of what went wrong here. The bank trying to hedge its credit risk just led to some massive losses. And I think what shareholders are really concerned about is Dimon, although he took the blame for the losses, really couldn't put his arms around how big they could be. They're $2 billion so far, and he said they're not quite sure where it goes from here.
I mean, Michael, Jamie Dimon has been labeled the king of risk management, so I'm assuming that his reputation's been damaged. Is his position under threat?
I highly doubt that. I don't think his position is being threatened. He did warn on the call that he was going to be taking some corrective actions, and we've heard from people inside the bank that while there's nothing happened yet, there will probably some heads will roll over this. So there will be some people probably let go over this. Jamie Dimon, it's highly unlikely he will be one of them.
Interesting to hear that. Highly unlikely that Jamie Dimon will end up
what happened at UBS, of course, with Oswald Grubel.
Indeed, we have some breaking news to bring you. First of all, Chinese retail sales. Also, Chinese industrial production.
Breaking news out of New York concerning JP Morgan. Our Eric Schatzker joins us live there now. Eric?
Emily, you may be wondering why we're talking about JP Morgan on a show that focuses about technology. It's because it's the biggest bank in the country, and let's not forget, it is one of the lead underwriters on the Facebook offering, although this has nothing to do with Facebook. JP Morgan reporting today a shocking, stunning, if you like, $2 billion trading loss in a part of the bank very few of us know anything about. It's called the Chief Investment Office. It's not the retail bank. It's not the investment bank. It has nothing to do with credit cards. It's the part of the bank that invests the bank's deposits. So in other words, you put money on deposit at JP Morgan. JP Morgan sends that money up to the Chief Investment Office and asks it to buy things that generate a higher yield so JP Morgan can make some money. We've known for some time, in fact, we at Bloomberg broke the story about 3.5 weeks ago that JP Morgan was taking on more risk in the chief investment office. It was a story that I was involved in together with several of our colleagues here at Bloomberg in New York City and also in London. And now, so soon after that, we're seeing the consequences of this risk-taking, a $2 billion trading loss inside the chief investment office. JP Morgan convened a very hasty conference call on which JP Morgan's CEO, Jamie Dimon, took part. In fact, he pretty much did all the talking. He said that the strategy behind this trading operation was flawed. It was poorly executed. He called the mistakes egregious and self-inflicted, and that JP Morgan violated its own principles. Certainly a black eye in addition to a big loss for JP Morgan shareholders.
And Eric, JP Morgan getting so much great publicity earlier this week as the Facebook roadshow took off. What happens now? Where do we go from here?
Well, the one thing that everybody listened closely for is the extent of the trading losses. And what Jamie Dimon said is that, quote unquote, pardon me, it could get worse. This could go on, unfortunately. He hopes to have it wrapped up by the end of the year. You know that people are going to ask questions. How could this happen? Regulators are going to be asking questions. Shareholders, creditors. The bloom, in some respects, has come off the rose as a result of this trading loss. The bank that could do no wrong all of a sudden has done wrong, has hurt its shareholders in the process. Everybody will want to know more about what happened. Back to you, Emily.
Eric, I know you'll continue to follow this story and bring us all the latest updates. Thanks so much, Eric Schatzker in New York.
And it is the fallout from JP Morgan's $2 billion trading loss. We've got it covered from every angle. Eric Schatzker is tracking the Wall Street reaction. Peter Cook has his eye on the chatter inside the Beltway. And Elliot Gotkin is over in London, where UK regulators are already asking tough questions. And Eric, you and fellow Inside Track anchor Stephanie Rule first broke the story of this massive trading position more than a month ago. So let's start with you.
Well, Scarlett, the reason JP Morgan shares are trading down so much today is not just because of the immediate impact on the income statement, that is $2 billion, at least in terms of gross losses from this credit trade, but the future implications. JP Morgan told us that the position is complex. It's very large. It's going to take months to unwind, and the losses could grow by at least $1 billion or more. You're also seeing the concern play out in the credit default swap market, Scarlett. JP Morgan credit default swaps rising by the most in basis point terms since February. Let me just give you a taste of what some of the analysts are saying. They're spreading these reports around, informing the street, trying to persuade investors what to do. Friedman Billings Ramsey, FBR Capital Markets, cut its rating on JP Morgan shares to market perform from buy. Same goes at Stifel Nicolaus. Goldman Sachs says that the losses add uncertainty and raise some questions about risk management practices, not just at JP Morgan, but elsewhere on Wall Street. Oppenheimer says that this raises questions about the public trust in financial firms. Now, let's also talk about what we're hearing in terms of the fallout, Scarlett, because that's a very key word. You mentioned it yourself, fallout. What we hear is going on Wall Street is that other firms on the street are feasting on this opportunity. We know that they're concerned about how to trade with JP Morgan because they, in many cases, facilitated this position. But JP Morgan is a sitting duck, Scarlett. This position has not been liquidated. It's still open. And someone I spoke to this morning in London who knows JP Morgan very well said the mere fact that JP Morgan had to disclose this loss before liquidating the position is a very good indicator as to the size, the risk, and the complexity that couldn't shut it down before having to come clean with investors. If the street were to take advantage of JP Morgan as a sitting duck and trade in such a way that it exaggerates the losses in the positions, we may be hearing from JP Morgan a good deal sooner than the end of the second quarter, and they told us last night that that's when we would hear from them next.
Gotcha. Thanks so much, Eric. Eric Schatzker at headquarters. Let's move over now to Washington because lawmakers, as you would imagine, are seizing on JP Morgan's loss as justification for even tougher regulation. Our chief Washington correspondent, Peter Cook, has more on that angle of the story. Peter?
Well, Scarlett, given what's been going on in the markets these days, the timing of this loss, not a good thing for Jamie Dimon from a market perspective. Eric just touched on that. Not a good thing from a regulatory perspective as well.